Common stock market definitions. Earnings per share, or EPS, is the portion of a company's profit allocated to each outstanding share of common stock. It's a measure of a company's profitability and can be a useful tool for investors when deciding whether to invest in a particular stock. A higher EPS generally means a company is more profitable. A stock split is when a company increases the number of its outstanding shares by dividing each share into multiple shares. The goal of a stock split is to make the stock more affordable to individual investors. Dividend – a portion of a company's earnings that is paid out to its shareholders. Short selling is when an investor borrows shares of a stock from a broker and sells them, with the expectation that the stock will decrease in value. The investor can then buy back the shares at a lower price and return them to the broker, making a profit on the difference. Short selling can be a risky strategy, as there is no limit to how much money an investor can lose if the stock increases in value instead of decreasing. Stop-loss order is an instruction to sell a stock if it drops to a certain price. A bull market is a period of rising stock prices. A bear market is a period of falling stock prices. A blue-chip stock is a stock of a well-established and financially sound company with a long history of stable growth and steady profits. Initial public offering, IPO. The first sale of a company's stock to the public. Market capitalization is the total value of a company's outstanding shares of stock. P/E ratio, or the price-to-earnings ratio, is a measure of a company's stock price relative to its earnings per share. The 52-week high is the highest price at which a stock has traded over the past 52 weeks, while the 52-week low is the lowest price at which a stock has traded over the past 52 weeks. Yield, the annual return on an investment, expressed as a percentage of the investment's price. Market order is an order to buy or sell a security at the best available price. A limit order is an order to buy or sell a security at a specific price or better. Day trading is the practice of buying and selling securities within the same day. Penny stock is a stock that trades for less than $5 per share. Brokerage is a firm that acts as an intermediary between buyers and sellers of securities. A market maker is a brokerage firm or individual that stands ready to buy or sell a security at any time, to help facilitate trading. The bid-ask spread is the difference between the highest price that a buyer is willing to pay for a security, the bid price, and the lowest price that a seller is willing to accept, the ask price. The primary market is the market where securities are first issued and sold to investors. A ticker symbol is a unique abbreviation used to identify a publicly traded company's stock. Trading volume is the number of shares of a security that are bought and sold in a particular period of time. Short interest is the number of shares of a security that have been sold short but have not yet been repurchased to close out the position. After reading these stock market definitions, you should have a much better understanding of common stock market terms and investing basics.